Hey everyone, it's Paul Nagpal from REMAX Hallmark and bringing you a late October update. So, just because this is around trick or treating, don't think I'm trying to trick you into anything. And I wish I had some real estate treats to give out, but just want to kind of give you a quick update. There's been a lot of movement recently in the real estate world, lots of announcements, etc. I'm going to try to cover all of them. So, I'm going to talk. I'm going to try to talk about interest rates first. I'm looking at my notes down here. Interest rates, talking about the market activity, talking about what the government's doing to tackle this, talking about One Bloor West, the project that kind of went into receivership. Looking at, I'm going to talk a little bit about the pre-construction market, and then I'm going to talk about the broad term. How does the market looking like in the let's say in the next 8 to 12 months? Predictions are a tough business. It's a terrible business actually. And I wish I didn't have to predict anything, but I'm just trying to give you my forward guidance based on my experience and background. So, without further ado, so interest rates, as we all saw, as expected, the Bank of Canada held rates in their last meeting this week, and we anticipate that we're hitting peak prime rates now, which basically means I think we're kind of reaching the top of the interest rate hike cycle. We don't anticipate too many interest rate hikes from this point onwards. Of course, there's so many things going on in the world. Um, the two wars that are going on right now in Ukraine, and then of course in the Middle East, they do have an impact on consumer sentiment. First of all, they do have an impact on the oil prices. Oil prices have an impact on inflation, and inflation has an impact on the interest rates. So lots of different moving parts right now, but I think the next interest rate announcement, which is in December, again, too early to say what the Bank of Canada will do at that point, but it seems like we're sort of hitting the peak prime rates. Um, Now, interestingly enough, you know, prime rates do not impact the fixed rate mortgages, and the fixed rate mortgages earlier this year were quite reasonable. They're quite reasonably priced. They were in the low 4%, low to mid 4%, um, and now they're sort of in the mid sixes to like from the high fives to mid sixes. So it's changed quite a bit, but that's obviously because it's based on a different market. It's based on a different index. Fixed rate mortgages do not. They're not linked to the Bank of Canada prime interest rate announcements. So I think, and again, depending on who you listen to, the analysts predict that middle of next year we will begin to see perhaps the bank considering to start to lower the fixed prime rates, and it's all up in the air because there's so much that could happen. The entire world is one big economy now. Something happens in Taiwan, it impacts us. Something happens in Russia, it impacts us. India stops export of rice, and it has an impact on our food inflation here. So it's an intertwined world economy now, and anything that happens on the other side of the planet impacts us. So it's very difficult to say where things will be in the next 6 months, but 6 to 8 months. But we think that in about 6 to 8 months, the bank's going to maybe start reversing some of these interest rate hikes that they've done. Um, the overall market in GTA, we are experiencing historic low number of sales. There's been very, very few sales. The months of inventory is building up, meaning the amount of houses sitting on the market that's building up. It's not catastrophic, but it's definitely slowly but steadily building up. There's a very distinct difference between the condos and the freehold market. The condo months of inventory, meaning the condo number of listings on the market, is significantly higher than the freehold. And one of the very simple reasons for that is a lot of investors had used condos as an investment vehicle. So people bought condos as investments. And now that the mortgage renewals are coming up and people are getting worried about where the market's going to head, they're trying to liquidate their investments. This is exactly how I had predicted earlier in the year. So as the renewals come up and as the numbers become less intriguing, or they become very cash flow negative, investors are beginning to offload those condos. And that's reflected in many different that's reflected in many different areas. But very simply put, there's a lot of condos up in the market, and which is having an impact on the prices. So prices are beginning to get soft, especially in the 416, which is Toronto, Metro Toronto area. 905, they're also beginning to come down, but more so in the 416. So lots of condos on the market, not as many freehold homes on the market. And again, if a property, for instance, is in a great school district, presents amazingly well, has all the boxes checked off, very desirable neighborhood, for instance, those properties are still selling. So as I always mention, real estate is extremely community specific. It's extremely area specific. So looking at broad, painting with a broad paintbrush is not the best way to do it. But I'm just trying to give you like a quick sort of overview of where the market is. So right now, what we're seeing is lots of condos, lots of houses too. But the price declines are more pronounced in the condo market. They're now beginning to show up in the freehold market because, again, on the outskirts of the GTA, a lot of investors, flippers, had bought freehold houses to buy and flip, which is basically they bought them and they never had the intentions to close them, and they were just going to assign them and flip them before they got before they closed. They were called for the closing, but that plan has backfired on a lot of people, and thankfully, 99.99% of our clients are not in that position. Most of our clients, vast majority of our clients, are long-term investors, not speculators only. So thankfully, our clients are not impacted by this, but this is happening quite a bit. As you also know, that I help a lot of clients secure their financing and their mortgages as well. So what I can tell you on that front is there is a lot of interest. There's a lot of intent. There's a lot of buyers who are looking to get pre-approved. There's a lot of sellers who are looking to upsize. They're trying to get their pre-approvals. And there's a lot of pre-approval activity, but these folks are just not qualifying for the new mortgage amounts that they're seeking because the interest rates are so high. So there's a lot of intent, but people are not qualifying because of the high qualifying rates. You got to remember, whatever rates you see out there, you got to add 2% on top as the stress test rate for them to qualify for a mortgage. So if you're getting a 5.8% fixed mortgage, you have to qualify at 7.8%. If you're getting like a 6.6 3-year fixed term, you got to qualify at 8.6%. So those numbers are absolutely staggering to qualify. And that's why people are not able to qualify and hence not able to buy, and hence the inventory is building up. So we'll see where it goes, but that's kind of in a nutshell where the current market sits. There's a lot of government action, as you've probably seen. Liberals were put on notice by the public that people are not happy. The general population is not happy with the housing crisis that's emerged in our country, more specifically also in the Greater Toronto Area, Greater Golden Horseshoe. The affordability just sucks. Literally, there's no other way to put it. If you are a young professional, even with great jobs, you're not able to kind of buy a house. You're stuck to a condo, and that's not a bad place to start. You start and then you kind of go from there. But again, high interest rates prevent you from doing that. So lots of government action on many different levels. You heard that there was a GST rebate that was being offered to the builders. You're now hearing about the ministers and the cabinet talking about potentially curtailing demand. What does that look like? We don't know, because only supply can't fix this, right? Like, you can't just keep building more homes. You have to slow down the demand somehow. And that's a tricky situation. That's a tricky subject of immigration. How do you slow down the immigration? So, you've got governments on all levels, provincial, municipal, and federal level, trying to throw everything at this fire, which is fantastic, which is great. Lots of different things being talked about, which is amazing. I just feel that it's a little too little, too late. So not to say that they shouldn't be doing this stuff. They should still be doing it. the GST rebate, the city of Mississauga talking about allowing fourplexes, the laneway housing program in Toronto, and there's so many more, right? Federal funding for different municipalities that they've been looking to pull back if the municipalities don't hit their densification numbers. So there's a lot being thrown at this problem, but I think it's just going to take a long time for it to kick in, and I don't know how effective it's going to be. So while I, as a professional, welcome all of this, and as a citizen, I welcome all of this, I just don't see how any of this is going to help us in the short term. The only trigger that the government has to kind of slow down the market in the short term is interest rates, right? And they've already done that. And if you remember earlier this year, when the government came out and said we're not going to raise rates, you saw what happened in the spring market. The real estate market just shot through again. And there's a very simple explanation for that. There's intent. People are looking to buy, but they're just waiting for the right signals, and of course the fact that they need to qualify for this. So I get a feeling that the moment the government now begins to talk about stopping raising the rates, so they're going to hold the rates, or maybe there's talk of a dovish signal, as they say, that they're going to lower the rates. I think the floodgates will open again on the real estate side. That's just purely based on demand, right? And I've spoken about demand a lot in my previous videos. Again, demand is being created by all the students that are coming in, all the young professionals that are coming in, and the countries where they're coming from. It's a very personal decision to hold and buy real estate. And a lot of the countries where these immigrants are coming from, it's very inherent in the nature to buy real estate. So anyway, without talking too much about that, that's kind of like the update there. You heard some big news, probably, if you were paying attention, about One Bloor West. It's a prestigious project, right at the corner of Yonge and Bloor. It was supposed to be like a landmark project, super tall skyscraper, but news came out that it went into receivership, and that kind of sent a massive wave across the circles. They went to receivership because the project was running behind. There was about, I think, a $1.65, $1.7 billion debt that these guys were in. They were behind. And people were just wondering what's going to happen. Will it have a trickle-down effect on the other projects in the area? Real estate bears were saying, oh, there you go, beginning of the end. In a couple of days, another developer came and just picked it up. Right. So now all of a sudden, the project that was destined for failure has now been picked up by another builder that is extremely deep pocketed, and they have the financial ability to see this through the end. And this just goes to what my comment always has been. For every argument that exists for the Greater Toronto or the Greater Toronto area or the Greater Golden Horseshoe market to collapse, a parallel argument exists and about why it won't. So, just a great example of the resiliency of our market, that, a building as prestigious as One Bloor West went into receivership, and a couple of days later, it was picked up, and it was sort of, that risk was mitigated. So again, that's something that talks about resiliency in the market. Talking a little bit more about pre-construction. So right now, pre-construction assignments are sitting on the market. The assignment market's absolutely tanking. If you're looking for a great deal that's going to close in the next 1 to 2 to 3 years, there's so many assignments you can pick up right now for people trying to sell at cost what they paid 4-5 years ago. So you can basically benefit from all that. And there's so many of those assignments. It's so tempting to pick up some of those. And a couple of our clients have already in the last month or so. But, you have to see if it suits your need, if it's on your investment horizon. So many assignments available. If that's something you're looking to do, if that's something that you're interested in, please do reach out to us. A lot of the pre-construction projects are delayed right now because obviously COVID threw a wrench in the works, so to speak. There's been material shortages, there's been labor shortages, so most of the pre-construction projects are kind of running behind, and most investors are not complaining at this point because no one wants to take mortgages at 7%, 6.5%. um, Builders are also adapting to the new reality. So there's the last few launches in the city have been quite interesting. Like, builders have adapted and they've kind of adjusted their price per square foot. And if they haven't been able to adjust their price per square foot to a large extent, then they're offering some pretty interesting incentives. For instance, we have this one particular project that we're working right downtown on Queens Quay, and the developers are offering some interest on the deposits. There's some other developers that are offering rental guarantees, and some other builders are offering mortgage top-ups, which is basically if there's any difference between your mortgage payments and the rent payments that you're going to get, the builder is going to cover that for a certain amount of time. So builders are trying to entice pre-construction buyers to come back in the market, and a lot of them are succeeding. A lot of the projects are doing very well. Pickering City Center, that first building sold out in a few days. Second building also in not too many more days. So there's a lot of still intent in the building in the market, and I think that's just a good sign. That's a good, healthy sign for the long-term viability of the market. I always try to say that, look, anyone who can withstand the next 6 to 8 to 9 months as a real estate investor, there's a literal pot of gold on the other side, because there's going to be so many opportunities. There's going to be so many things that are going to be going right. So anyone who can hold on, they should hold on. I personally believe in the longevity of the market, of the Greater Toronto Area market. As long as there's people coming in, as long as we're not building as many homes, the market's generally going to trend in the upward direction. Of course, we're going to have the ups and downs. No market just goes straight line up. You've got the many ups and downs, but the longer trend is upwards. And again, we're in this down cycle right now where a lot of investors are going to make money, right, in the near future. The immigration numbers are holding steady. I think that Canada is still seen as a very desirable place to come in, even though to a lot of people who live here, it seems very broken at the moment. People are very disappointed about the housing prices, about the healthcare crisis, about the education issues, education system kind of falling apart. A lot of issues. But to the outside world, people outside Canada, it's still a very desirable place to be, and it is a very desirable place to be. So as long as people are coming in, it's going to keep that demand floor in place. And the one big important thing for everyone to understand is that the construction starts, which is the number of houses, condos being constructed, that's just absolutely tanked. And that's got to do a lot with the market activity, where the market sits right now, what the demand in the market is today, also what the interest rates are today. So, one of the side effects of high interest rates are construction loans are expensive for builders, right? Loans to buy land are more expensive. So builders have pulled back. And what that means is construction starts, the number of how homes and condos being built, that's declined a lot. Guess what's going to happen? In 2-3 years, we're going to have almost no supply, right? No fresh supply, nothing that's already been sold. But in the next 3 to 4 years, all of a sudden, we don't have any, a lot of new houses or condos coming to the market. But at the same time, we've got all this demand that is hoping to buy. So again, we're going to run into the situation where the demand and supply dynamic will lead the price higher, I think. Again, predictions are terrible business. Predictions are tough business. So anyway, that's what's happening in the market right now. Sorry about the long video, but if you have any questions about your specific home, your specific investments, if you have a mortgage renewal coming up, don't hesitate to reach out and I can give you some guidance on should you stay with your existing lender or shop around, which you always should. Why not? Money saved is money earned. Anyway, thanks for watching. And if you have any questions, I'm more than happy to answer them. Have a great rest of your day.